Hello, everybody, and thanks for coming today to this data learning meeting, weekly meeting. So today we have Professor Irena Vodenska from Boston University talking about the future of finance and economics, the crossroad between models, data, and artificial intelligence. Looking forward to seeing what Irena is sharing with us, and thanks, Irena, for coming. The audience is yours. Thank you.
Thank you. Thank you so much, Rosella. Thank you so much for inviting me. And thank you, everybody, for coming to the talk today. I would really be excited to hear your comments, questions. And also, I wanted to say, feel free to interrupt me at any time or just as you feel like if you ask questions, you don't have to wait until the end. Rosella, how much time do I have in total?
So we are finishing at 5 p.m. I will leave, let's say, 10 minutes for questions. Okay. So you have 45.
Sounds good. Great. Sounds wonderful. So my name is Irena Vodenska, and I work at Boston University, and I have been at Boston University since 2002. And within that time, it has been an interesting path to do research in various different areas, but somehow they were all interdisciplinary. And it is something that I believe in interdisciplinary research, and it has been part of pretty much since the beginning of my research career. So this is an intersection of finance, economics, statistics, computer science, physics, and you will see it's fairly interdisciplinary, and the approaches that we use are mainly applied from other disciplines. So it's something that we'd like to look at in a different angle into economics. So of course, the theory is very important, but at the same time, we realize that data is also very informative, and it is going to be very useful if we actually introduce or include the data in explaining certain trends or dynamics of economic systems, or even getting intelligence from what the data tells us. And in addition to the data, which has been used for quite a while in empirical economic research, the role of artificial intelligence is actually augmenting the possibilities of what we can do with the data. So I will start with a very brief introduction, give you some background, and then talk mostly about natural language processing and how we use it in some cases of studying the economic and corporate and financial systems. I'll talk a little bit about the data, the models, and some of our results, and conclude with some remarks and ideas for future work. So this research is done in collaboration with Dimitar Trajanov, Kostadin Mishev, Anna Todorovska, Anna Georgievich from St. Cyril and Methodius University in Skopje, North Macedonia, and Wataru Soma from Risho University in Tokyo, Japan, Hideaki Aoyama from Kyoto University in Japan, and Lou Chitkushev and Hyunuk Kim from Boston University. So when we think about this research and the people that I just mentioned as collaborators, pretty much none of them is in economics except for me. So all of them have different backgrounds. And the main question that many people in economics are interested in is forecasting or predicting a trend. And then we all somewhat would like to have a crystal ball, but we don't. And we'd like to be as accurate in forecasting as possible, but we all also know that we cannot predict the future, and that history that we study does not predict the future. And this is mainly due to the efficient market hypothesis, which has been contested or strongly believed in. What level of market efficiency are we living in? Is it very strong form efficient, or is it weak form efficient? So they're questions that are still existing. So we include in the research a multi-dimensional look into the complex economic system. And of course, it is not static. And the moving pieces also that influence the entire dynamics of the economic system are not static. So we have a company, for example, and we have trade competitors that affect the profitability of the company. And in time, that definitely changes. The companies need to develop and pivot in their products and be current with the trends. Then we have the macroeconomic uncertainties. We have the Federal Reserve Board meetings and their decisions on interest rates, whether to increase, to decrease interest rates. As a matter of fact, just at this time, when we're getting out from a very low interest rate environment, we see that the financial markets are nervous, and the expectations of raising interest rates creates uncertainty and higher volatility in the financial markets, because the inflation starting to show up in the economy. And so the traders, the investors, the market participants have their eyes on the market, on the Federal Reserve, on the other central banks, and what they're thinking and deciding about in the future, and how to basically keep the economy stable. And then we have political events. So they definitely influence financial markets. And even if the political event happens on the other side of the earth, financial markets are global and investors are global, and we live in a global banking system, and we are basically not isolated islands. So political events affect us too. And then we have national or local events and global events. So we need to gauge how much a certain national event spills globally. And it's without a doubt that the largest markets, and some of which are in the United States, affect the behavior of other markets in the world or other economies. And then we have the media effect. And so this is the angle that is new in our research, in our approach. We like to measure, we like to explore and harness the power of media and what the media tells us about the financial market or the future or the economy. So as an introductory remark, I just wanted to give you this picture where we have been as far as the paradigms of science and where we're now. So basically, if we can call the first paradigm of science being the empirical observations, and some examples will include the computing the area inside the circle. So Archimedes basically used the method of exhaustion to just come to the circle and compute the area. Or if you think about the Pythagorean theorem, which is the probably most famous theorem or most famous mathematical contribution, was again a observational. It was empirical observation and then creating a mathematical expression out of it. So according to a legend, Pythagoras was actually so happy when he discovered the theorem that he offered a sacrifice of oxen. And then moving into the second paradigm of theoretical models and generalizations. So we can think of Newton in this area, or we can think of the university law of gravity or the three laws of motion. And often Newton is, we like to call him the first econophysicist. And he actually invested heavily in the South Sea bubble, which ended up as a huge fiasco when the company didn't deliver what it was promising. So Newton invested in the South Sea bubble, made a fortune, and then lost that fortune. So one of his famous quotes says, I can calculate the motion of heavenly bodies, but I cannot calculate the madness of people. So think about that. There is that amount of madness, or today we call it either panic or overreaction in a certain trend of the financial markets. So then the mathematical models can take many forms. They can represent dynamical systems. They can be statistical models. We can use differential equations to express a system, or we can look into game theoretic models. And then as the computing power became more powerful, even in the past, in the third paradigm, when we talk about computational science, we look into the power of or the speed of what the computer can do versus what the human can do. So it is in a way not just letting the computer work without any monitoring or input. As we know, if we give garbage to the computer, we will get garbage out. But when I think about computational science, I'm thinking about the beginning, the mainframe computers, the IBM. And if you haven't seen the movie Hidden Figures, I highly recommend it. It's about the female scientists or female computers at the NASA and how they helped with the Apollo mission. So, and then there are simulations that were being possible at that time with the computing power, and that was very exciting. But today we're even beyond that. We're in the fourth paradigm, and this is the data exploration, or e-science. It is data-driven science. So the fourth paradigm, in a way, is data, abundant amount of data, to which we need to apply knowledge, and we'd like to have either recommendation or action, or empirically to understand what we get out of putting the data and the knowledge together, how helpful, how useful that is. So the data these days does not come only from structured databases. It's actually very unstructured to the great extent. And then the knowledge, it's not only coming from thinking or applying a historical knowledge, but it also employs the computer to help with that. And then in the action, there is a certain creation of a tool, for example, or a software that will help a human being in everyday's work that they do. So a little bit of a background, and I think when you think about background, it really depends on what you want to look at. You wanted to look at these very structured high-risers, very architecturally positioned, well-defined, or you wanted to look at also nature, meaning the trees pretty much can start growing in one way and then they turn in a different direction, or they get together. The roots have their own way of expanding and so on. So both. And this is a synonym to unstructured and structured background. But to think about what is the history actually of artificial intelligence, it's not new. And this is a brief 65 years of booms and busts in the artificial intelligence history. So if we go back to 1956, the Dartmouth conference at the time gave birth to the field. And the definition is the AI is a discipline of building machines as intelligent as humans. And then you stop there and you think about it. And it's a bit disconcerting. And you may want to take a step back and say, do we really want to build machines as intelligent as humans? So if you go and think about 10 years later, and Herbert Simon, who is the economist, he won a Nobel Prize in economics in 1978, said machines will be capable within 20 years of doing any work a man can do. And we have some work that machines can do, but we can argue that doing any work a man can do, maybe not. So then there were certain winters or dark periods or dark ages in the artificial intelligence history. And the first one was in between 1974 and 1980. And here, basically, the frustration was, this is the time of the Cold War, and the frustration was, for example, with the failure of translation automation from Russian to English, or then the main problems that were encountered were either not enough computing power or lack of data available. So we don't have that problem today, but maybe we have the opposite problem. We have too much data, and okay, there is never enough computing power, but it is the opposite problem in a way that we like to keep that proper study of the theory and then just have the data and the computers as a auxiliary help to what we would like to study. And so Herbert Simon actually said a wealth of information creates a poverty of attention. So we want to be mindful not to get there, not to be poor of attention. So we want to have the wealth of information, but we also want to have this richness of attention, and this is important. And then the second artificial intelligence winter was when the new generations of desktop computers started, and then the IBMs and the mainframes became almost obsolete. So then we can move forward and think about IBM's Deep Blue. It beat Garry Kasparov in chess, or even to these days, entrepreneurs such as Andrew Ng doing some breakthrough research on deep neural networks. And he's a co-founder and led Google Brain, and was a former vice president and chief scientist at Baidu. So he was building the company's artificial intelligence group, and this grew to a group of thousands of people. He's also an adjunct professor at Stanford University, and he pioneered online education. So he co-founded Coursera, and he also launched a artificial intelligence fund, meaning investing in funding or backing artificial intelligence startups. So when we think about artificial intelligence, it's a very big field, and then we'll talk about machine learning and then deep learning to narrow it down, so to speak, and then some of the differences and what are the very focused approaches that we have taken in some of our research. So the paradigm shift, in a nutshell, tells us that we are done with traditional programming, where we have the data and we tell the computer what to do, and then we have the output and we're done. In machine learning, we basically use a very rich information or the output to feed it back in the computer. And in the simplest possible explanation, we use that information to make the output better as we do this. So why is deep learning so attractive? Because if you look at the left-hand side on the bottom, when we move from shallow to deep learning, the classification error decreases, and it decreases drastically with the development of certain deep learning processes and procedures and types of networks, and then including, in addition to just doing serial neural network flow, to do recurrent network flow. And so once it came down, the classification error in the deep learning environment dropped below what a threshold could be. If we think about the human error, then it gets people's attention. Now, the main criticism of deep learning and neural networks is that it is a black box, and we don't really know how exactly the computer makes the decisions. And so deep digging is warranted. And if we translate this into using neural networks and deep learning in finance and economics, these are very highly regulated systems. This is not some isolated scientific basic research project that doesn't need to worry about regulation and transparency. So in economics, it is very much number one consideration, whether you can do something useful under the framework of regulation or under the framework of what the policymakers would deem or consider safe or acceptable for clients, because we have people that are involved in the decisions that a financial institution will make is going to affect the outcome for people. And just one example, if a financial institution gives a loan to a person and it involves machine learning algorithm to decide whether this person should be given the loan or not, that person's life can change based on their financial outcome or the decision by the machine. So most of the time, it's not really just the machine that makes the decision, human is involved. So especially with machine learning, and this is where we are basically in the industry, not much deep learning approaches have moved to the economic system. But with machine learning, the feature extraction is still in the hands of the human. So the human still decides what's important to input in the decision-making tool or in the hidden layers of the network. While the deep learning, we just put everything together and then the machine actually decides what's important and what to take in consideration when making the decision. So I'm going to talk about two of the four projects that you see on this page. So they all include natural language processing, and we use this approach in forecasting corporate revenues, in predicting the price of Bitcoin and other cryptocurrencies, or in macroeconomic expectations post-COVID-19, or environmental, social, and governance aspects of the companies versus greenwashing, which really means that companies may claim that they are green, but they're really not. And so how do we decide that? Here we use the S&P Global Market Intelligence approach, and it is very new. It just came out about 6 months ago. What I'm trying to say is natural language processing is used in the industry, in the financial industry, not just in academia, not just in computer science, and not just in interdisciplinary research. So let me start with the corporate data and the corporate project, and how do we use natural language processing to forecast corporate earnings. So we looked into the 30 major US companies that are part of the Dow Jones Industrial Index. And that is the data of, we use the Securities and Exchange Commission reports, because the companies, they're publicly traded and they're required to report with the Securities and Exchange Commission. And all their quarterly reports and annual reports are public, and they're very readable, so to speak. So the quantitative data is easy to extract, but there is also a lot of textual data in these reports that we use in the analysis, which we use it through text sentiments. And we also use the news articles from the GDELT database pertaining to these 30 major companies, and Thomson Reuters News Archive, also articles pertaining to the 30 major US companies belonging to the Dow Jones Industrial Index. And then we use stock price data or market data. Why? Because the reports are very low resolution. They come quarterly or annually. And then before we hear about any information that could possibly tell us where the company is going in the future, whether they're going to be more successful or less successful in their business, is by quarter. And then there is a earnings reports, and the earnings reports usually move the markets. So when the company has certain expectation that they will earn, say, $1 a share, and then if that actual number that comes is 90 cents, that is a pretty much of a disastrous day that awaits the company. If it's $1.01, it's a wonderful day. So it basically thinking about either under performing or overperforming. And so we use this market data because they're higher resolution data. And then we use the financial sentiment analyzer that we created. So how did we create this financial sentiment analyzer? We used a domain knowledge based on the Legrand-McDonald Financial Sentiment Dictionary and the approach that S&P Global Market Intelligence used by using this dictionary. So the approach involves the universal sentence encoder as the embedding layer, and then we vectorize the sentences that we create from the LMD dictionary. So how do we do that? Well, the dictionary basically gives us a list of positive and negative and neutral and litigious words, but they're not regular dictionary words. They are very business and finance and economics oriented. And what I mean by that is, for example, if you use the word share, share is usually a positive word in regular dictionary. Share is a very neutral word. It's a no information word because we're talking about shares of stock, for example, shares in the company. If we think about the word liability, liability is a very negative word generally, but in finance, it's very neutral. It's just a right-hand side of the company's balance sheet, meaning they have some assets, they have liabilities, and that's the nature of how the financial statement looks like. So, so we use this topic-based dictionary to create. We take 5 words from the Legrand-McDonald dictionary and build sentences. And we have 120,000 sentences with positive sentiments and 120,000 with negative sentiments. And then we use the financial phrase data set. This comes from Aalto University in Helsinki, Finland. And this is a about 2,000 sentences manually annotated with the positive and negative labels. So we test these training set that we created on an unseen testing set. So then what we do is we go to our data. So we have the news articles from the Thomson Reuters news archive, and then we annotate them and we create sentiments for these articles, for the sentences using the universal sentence encoder. And in addition to using the sentiment, which is we either have positive polarity or negative polarity on these sentences, we also use the stock price data as input, which we use the open stock price, close, the low and the high for the day, and the trading volume. So these 2 streams of data related to the companies are an input in 3 different approaches: in the long short-term memory network, in the convolutional neural network in combination with the LSTM, and the conv-LSTM combined model. So from these 3 approaches, we see what our results look like for different network models. And the accuracy basically increases and is highest for the combination model. So after this research, we started to move from lexicon to word encoders to sentence encoders, paragraph encoders, and then did the testing. We tested over 100 different models. We went all the way to transformers and to some of the variations of the BERT transformer. It was Roberta that gave us the best results in different tasks. So this was very important to look at. It's very low resolution data, and corporations depend on what the news say about them. So when there is bad news, there is a reaction. There is good news, there is a reaction. But then we saw that basically the world in cryptocurrencies, for example, is not very dependent on what the news say about the crypto. And we thought and thought and thought about it. We couldn't find filings. Cryptos are not companies, and they are not filing reports with the Securities and Exchange Commission. They do not have fundamentals. Mainly, they do not have a product that they offer to the clients. What they are is still not clear today. But crypto is either a currency or it's an asset. But there is a big difference between the currency and an asset. Why? Because if it's a security and it is deemed to be security as people invest in it to earn profits, and it trades publicly, it needs to be registered with the Securities and Exchange Commission. But if it's not, then it doesn't need to be registered. So there is a lot of movement in the regulatory space around crypto. And certainly they're not obscure or marginal, I would call them currencies, because we can today buy products and services using Bitcoin, and we can do it globally. So we don't have to exchange dollars for euros and so on. If we just have our wallet and use our crypto, that is fine. But the volatility of cryptocurrencies is something that creates an extraordinary risk in holding these kind of assets. So one day we can have a crypto being worth $1,000, and the next day it can be worth $10,000, which is a very high risk in the system. And then they move together. So the interconnectivity becomes a fundamental feature of these digital systems. So in addition to looking into what moves crypto or trying to understand what moves crypto, we talk to younger people. And so these younger computer scientists basically said, well, we have to look at social media. And that's what we did. So it is very novel concept, but also I think in the generationally younger people is a mainstream, right? So they're very disruptive in the context of traditional finance, but since they're very present, we cannot ignore them. And so they increased in popularity, and we wanted to look at some social media comments and how they moved crypto. So we pulled one tweet by Elon Musk that when he said you can now buy Tesla with Bitcoin, Bitcoin price skyrocketed after that statement. Or the impact of just one sentence, or depending on who is the person behind the social media account, is extraordinary. The movement that it provokes, so the impact is unbelievable. And so there is a lot of data or text in sentiment that you can extract from the social networks. So we looked at Facebook and Reddit and Twitter and other. And we also looked at the GDELT database where we have headlines for the news on daily basis with a timestamp and the titles of the news. So we looked at the GDELT news articles pertaining to cryptocurrencies. So we took 18 most liquid and biggest cryptocurrencies to do this research. So we looked at the social media and what the social media says about the cryptocurrencies, and we looked at the prices. So we took these quantitative data, even though it is very hard to use history in cryptocurrencies, historical prices, and predict the future. The results were surprising, and I'll show them in a second. But think about it now. Our hypothesis is that prices do not predict, the historical prices do not predict the future, because we believe that markets are efficient. And our hypothesis was one of them, that the social media in a previous instance of time could be very predictive of the price of the cryptocurrency, which we have seen in certain instances. And then we use the natural language processing model. In this case, we use the Roberta transformer to find what the sentiments of the cryptocurrencies that we studied, the 18 cryptocurrencies that we extracted, what will the sentiment be for each social media post, for each text, and then use that to forecast not only the price of specific cryptocurrencies, but how each cryptocurrency might affect another. And then we took these 18 cryptocurrencies, some of which you may be familiar with, especially with Cardano or Bitcoin, of course, Celsius, Neo, IOTA, Dogecoin, Ethereum, Litecoin, EOS, and so on. Ripple, of course. And we took the history and the structured and unstructured data of these 18 cryptocurrencies. And what we did is we extracted the sentiment from the Reddit posts, from the Twitter posts, and from the GDELT news articles title. We wanted to see which one has the biggest effect, if any. And we took the cryptocurrency prices, the open, high, low, close price, and volume, and went into using the XGBoost model, which is the time series forecasting model in the context of machine learning. So taking this temporally organized data, these 18 data sets where we have the prices, the sentiments, and we wanted to forecast where the prices are going to be in the future and who or which aspects, which factors are going to be the most important in influencing these prices. So the XGBoost is a machine learning model that enables time series forecasting. And we have these temporally aligned prices and sentiments as input. And then the objective is to predict the cryptocurrency price. This is the initial objective. We also include the simple moving averages for the prices and the exponential moving averages as inputs. So we did this for the time in the 2019 and 20. And then the last piece of data from September 1st to September 30th of 2020 was used as a test data set. So we repeat this process for all 18 cryptocurrencies. And this is just one example. We have this same results type of plots and accuracies for all the 18 cryptocurrencies, but this is for Litecoin. So we have the actual is the red line, and the green is the predicted. So it seems that it is quite close, but what we wanted to know is what actually drives this prediction. So there is a certain area, there are areas with the overshooting or undershooting of on the forecast in time. But then we wanted to find out what are the features that are the most important and what is the relevance of these features. So each feature, except for the historical price, is linked to one media source, either the GDELT or the Reddit or Twitter. And then we use the SHAP explainable AI model to look deeper into the features. So we looked into each feature separately, and then we assessed the model performance by looking into the most important versus the least important. So we order them hierarchically, and it shows us the degree of influence of the different social media or news archives over each cryptocurrency. So this is the values. These are the SHAP results. And you can see this is the highest influence will be the previous close price. This was very unexpected. And so it turns out if you look at it, the quantitative data surfaces and the close price and then the open price for the day. And then we have the moving averages have certain influence. And after the simple moving averages, the exponential moving averages for 20 days, for 30 days, and we tried many to see which ones make sense and can be useful in forecasting. After that, we see the sentiment, the Reddit sentiment or the GDELT sentiment showing up. And it's not that they do not have effect. Obviously they do. It's not a especially exactly on the zero line their effect, but it's not that great. It's somewhat very small. And so this is a puzzling result for us, and it certainly warrants a further exploration. This is a work that was submitted to a conference, but it's still work in progress, and it's still not published as a paper. So to conclude, I just wanted to say a few things. It is very hard to, first of all, forecast anything, especially forecast financial markets or corporate outcomes. And because most of the factors that affect them, that influence them, are a moving target. And one factor that's probably the most involved in moving the economy and the financial markets is the human being. And as human beings, we are thought to be rational, but often we are irrational. And especially if you think about the downturns in the market, when do the biggest overreactions happen, made by human beings, of course, is on the downturn of the market. The behavior, the reaction, the dynamics of the market is very asymmetric. It moves very slowly and orderly on the upside, and it moves very rapidly and violently on the downside. So news move markets, traders, investors, market participants are irrational. And this is what we have to deal with. So how do you predict a human behavior? Now that's a whole other area of behavioral economics, which is becoming very prominent and mainstream these days. It is interdisciplinary, of course, between psychology and economics, but behavioral economics is becoming very prominent. So the traders react, right? So what I wanted to bring to your attention as a conclusion is when you think about this sentiment analysis model and their performance, there is a very fast development and improvement in accuracy from the lexicon-based methods back in 2011, 12, 13, moving towards the statistical methods or word encoders, sentence encoders, and then using natural language processing transformers. But the bottom line is we need to keep in mind in all these different approaches, we need to have a trade-off between transparency and the black box and regulation. So this is a paper that we published back in 2020, and it's the evaluation of sentiment analysis in finance from lexicon to transformers. I think it's a collection of different methodologies. So for tools or results based on different tools, it's like a survey paper, and it was picked up about a week after it was published by Towards Data Science. So there is also an article on it if you're interested in reading. So to conclude, how do we think about corporate versus crypto? Corporate meaning mainstream or the dollar bill behind. So, and then the Bitcoin coming as a digital coin and as something that many argue will replace the regular old-fashioned currencies. So basically one aspect of it is, and I'm not going to talk about it, but think about it, the central bank digital currencies, and that is reality. So when central banks get involved in digital currencies, then the chances are that they will stay to a certain extent and be under certain jurisdiction of central banks. But if you think about it, the old versus the new and the confluence of the two creates enormous challenges for the global economy. So different sources affect the outcomes of different aspects of the economy. And then investigating the degree of news and social media influence, in addition to the quantitative data, meaning price and volume, is important. Using this unstructured data, making a signal out of this vast lake of noise is important. And then one very important aspect, the volatility. The increased volatility introduced in the financial systems by having these new assets and currencies is very challenging, and especially when the asset does not have a fundamental value. So as a future work, we are going to become better friends, I think, with the computers, with the robots, and hopefully they will help us in what's next. I think it's important to use the power of natural language processing to untangle the dilemma between the environmental, social, and governance claim by companies and greenwashing, basically finding the truth. Natural language processing can help there. Expanding the forecasts of the effect of COVID-19 or long COVID on the global economy, unemployment rate, minimum wages. The economy is, it seems, in a paradigm shift. And the big question, can we improve economic stability by utilizing the power of news, sentiments, and social media trends in fundamental research? So I will stop here. Thank you very much. You can find me at vodenska@bu.edu. And if you have any questions, I'll be happy to answer.
Thank you very much, Irena. It has been an amazing talk. And yeah, if you have any question, you can either raise your hand or type that in the chat. In the meantime, I have a few questions, but I don't want to take all the time. So I will check if other questions come in the meantime. But yeah, first of all, just to comment that one of our, the component of our group, which is a PhD student I supervised over the past 3 years, Philip, is now has started working on the European Bank on the digital currencies, so the digital euro. So it's like, it's real. So,
of course.
so 3 years ago, when we started, working on the PhD project, it was like, who knows? And then just in time,
Right.
so perfect place for him. So this is definitely real, and this is the future. So
I agree. And Europe is actually also very ahead of the curve into the ESG area.
yeah.
Basically, the environmental aspects, I would say Europe is leading there, or the social or governance. So there are lots of lessons to learn in sense of, we're all global, but then certain either countries or group of countries are more ahead of the curve, so to speak. And then in our research, we realize that once we start reading about the movements in the real world. And I think it's very important to connect to the real world. So it's great that you or somebody from your group is working on the central bank digital currencies. That's exciting.
Yeah, it's very interesting also seeing how it works in real world scenario. No? But yeah, and so let me check if there is any question. Guys, don't be shy, please just unmute yourself if you have questions. If not, I will start with my question. So actually, I was wondering, so first of all, in terms of dynamic of your model, how is it working? Is this adjusting every hour, day, week? So how many times it's, so I was wondering about the dynamic behind that. Yep. And my second question is, as you have been mentioning different sources like Reddit, but probably Twitter too. So I was wondering, do you implement any data fusion for this data, or you prioritize Reddit instead of Twitter? So what is your way to choose data?
Yeah, so the model is basically trained on a certain data set, which is in the past or from the past creation of a corpus. But the way it works, it can always be tweaked by what inputs do we have, or what is the history that we take in consideration, and what is the size of the testing set, for example. So we can even skip a time because the training can happen in the past. And then if there is a period, let's say the period of COVID was very peculiar. This is not a representative past, right? We hope not, of what will happen in the future. So in sense of the dynamics or what data in the history we use, we take it out because it is really not representative, and we don't believe it is going to present well the future the way we envision it. So what I'm trying to say is this is more of a combination of science and art, because the institutional knowledge or the backdrop is very important. So for any research in economics, we really need to be mindful of what kind of environment we live in, or what kind of environment we expect, because it's really about the expectations. Even when you invest in stocks, you don't necessarily invest in a stock because of what is it doing today, but you're investing in the expectation, or what is this company going to do in the future, because your investment is the future.
Yeah, true.
Otherwise, today it's already embedded in the price. And so this is why economists have this fascination with the future, because it's all about expectations. It's all about that next happening. It's all about the margin. It's all about what's coming to be informed. And even policymakers, and I think governments that are now involved in digital currencies, they're just mindful of what is happening. And the banks are basically implementing blockchain into their operations, because even though initially it was regarded, as you said, as maybe a interesting side project for a computer scientist who is very interested in doing something new, this is becoming mainstream. And the big institutions are starting to understand that they cannot ignore it. The technology behind, the cost saving that it will bring, the time saving that it will bring. So all of the above is coming together and into consideration. And as far as your second question about do we do a confluence of data, for the time being, we keep them separate. We keep them separate and apply the model to each data set. They're different in a way of what we can extract from different social media. So if we combine them, then we will have a lot of unknowns in a way in the input space, because maybe we do not have for example, the title of we have only the title of the GDELT database or the headline versus we have the entire text on the tweet and what the tweet was saying. So it's a bit of a different input. So we'd like to keep it separate somewhat. Then if you look at the structure of all three of them, this is what I wanted to say. If you look at it, for example, we do have the number of comments in the Reddit post in the score, and we don't have that in the GDELT because it's a news, it's the title of the news. So the inputs are a little bit different for each of them. So on the Twitter, there is an ID, and there is a who, of course, tweeted it. The date is important, we have it in all of them. But we also have the URL for the tweet, and we can always see if there is a certain extraordinary influence. We'll kind of can backtrack it and see where it came from and what did it say to move so much.
I see. So, but sorry, I always do that, so I'm keeping probably all the time, and we have to close the meeting. But so the input is not the sentiment, it's the data itself.
The data itself is the input in the sentiment analyzer. So once we obtain the sentiment of all of these three different sources, then we use it in the XGBoost model as one of the features. So there is a feature from Reddit, there is a feature from Twitter, and there is a feature from GDELT sentiment. So we take these three sentiments as input into the forecasting the price, in addition with the quantitative data, which is the price and the volume.
Yeah, it's clear now. Okay.
Yeah, so it's 2 steps, yeah.
Yeah, thank you. Any quick question?
Hiya, I've got a question.
Yeah.
When you showed the sort of list of your features in the model, and they were kind of ranked in their predictive capability, a few slides down, you mentioned that previous market close was the most powerful in predicting, and that was a surprise to you?
It is a surprise to me.
I was
yes.
kind of, yeah, I was wondering, because that kind of seems to me like an obvious thing that it would be if, you know, if you've got a previous price of this much, then the next price is likely to be quite close to it. Is that, have I misunderstood that?
No, you didn't misunderstand. The whole theory of you cannot use the past prices or history to predict the future then goes down the drain, because this means that markets are not efficient. That if I look at the price yesterday, I can predict the price today, right? So then that's a clear cut. Then if that is the case, why not sitting in front of the computer and trading today, or every day for that sake, based on what I know from yesterday, and make money?
And the model is trying to predict a specific price, or just kind of like a change in price?
Just a change, just a change in price, yes. And so that's what I'm saying. Let's say I sit down today and I have the previous close, and based on that, I can predict the price. It's either going to go up or down tomorrow. If I predict it goes up, I will buy that stock and sit on it for the day. If I predict it goes down, I will sell it in the beginning of the day and wait for it to go down. But that is not happening in the market, or I don't know of anybody who can consistently do that. That's why I said it's a surprise, Theo.
Okay, thank you.
What you're saying makes sense. I mean, it makes sense. It's very close past, right? It's not 3 years ago. So it's very close past. And this is why maybe the exponential moving average is a good way to look at it. And it comes quite high, the exponential moving average for 20 days back. So, but it's a question of how consistent and how persistent this can be. And then as every model, and this is a disclaimer to any researcher, I believe in this space, it is possible that we picked the training set and the testing set to obtain these results. So let's pick another time, or let's pick another environment and see how it works. And it will be different. So this is why every time this type of research has to be revisited, revised, and checked and tested for robustness at different times. And the results will be different. So this is why it is not possible to be persistent and consistent in beating the market.
Unfortunately. Otherwise, we would be all very rich. And yeah, thank you, Irena. Any final question? I think we really are passing. So if not, I think Irena will be still happy to answer your question if you can send her an email. And so, yeah. Also, I will send you in the next email to the mailing list also the email address of Irena, so you can contact her. And before closing, I want to share with you the 2 calls for papers that we have now open. So I will just share my screen.
I will unshare.
Okay, and okay, so I can share now. So I will send that in the email again. So essentially we have 2 calls for papers. One is for the call in the International Conference on Computational Science. ICCS is a top conference for computational science. So especially, novel works are very welcome. And we have the possibility to submit either an abstract or a paper that would be published on Lecture Note in Computer Science. Deadline 18th of February. And the second one is a journal paper. The special issue is Machine Learning and Data Science for Dynamic Systems. Same topic, but this is for a journal paper. So no networking, but just sharing of novelties in your work. And the deadline is the 1st of March. So I will share with all of you again these calls in case you are interested. Your contributions are very welcome. And I want to thank you, Irena, again for joining us today to the DataLearning meeting. And hopefully we will meet her in person in London soon. So thank you again, Irena.
Thank you so much, Rosella, and thank you, everybody. I do appreciate you coming to this talk, and Rosella, thank you for the invitation. Please stay in touch and get some great research going.
Yeah, let's do something together.
Absolutely, we'll be happy to. Have a great rest of the day.
Thank you, you too, and thank you, everybody. Bye.
Bye, thank you.